So I was saying, welcome everyone, and thank you for joining this presentation on systematic trading. I'm very happy to present Alex Christop, our Director of Education and mentor to many of us who know him on the group and worked with him for many years in the field. And with no due delay, I'll let Alex take over, and hope everyone enjoys this presentation.
Okay, thank you, Doran. Good afternoon, everyone. My name is Alex Christop. I'm the Director of Educational Programs of the Algorithmic Traders Association, and today we are discussing systematic and algorithmic trading in various forms, the benefits they may bring, and prerequisites required for successful operation of each type of trading. This webinar continues the series of webinars in which I explain the basics of the Certified Algorithmic Trader program offered by the association and the educational course in systematic trading, which I developed working at my company EdgeSense Solutions. First of all, at the risk of being self-repetitive, I still have to remind you the difference in terminology, especially for those who attend our webinar series for the first time. It is absolutely essential for understanding all further discussions that we will be holding in these and further webinars. Besides that, I believe that our brief trip into history might be amusing by itself. Originally, the term systematic trading was used to denote something opposite to discretionary trading. This very term emerged along with the development of pocket calculators that allowed to quickly compute very complex technical indicators such as relative strength and even moving averages. Today, this cannot cause anything but smile, but in early 1970s, it was a real technological breakthrough. However, indicators were not the very breakthrough in trading. They opened a new era of making trading decisions, formal, based on calculations rather than emotions, and following a predefined plan. There are many differences between systematic and discretionary trading, but if we decide to point out only the key differences between them, then we could mention the following three. First, a discretionary trader opens positions mostly because he feels like it. It's possible that he bases his decisions on an economical analysis of any kind, on sentiment analysis, reading newspaper, talking to fellow traders, collecting rumors, or any other ground. But in any case, the reasons for his decisions are qualitative, not quantitative, and cannot be formalized and quantified. Well, at least they could not be quantified back in 1970s. A systematic trader, on the other hand, first develops a trading system that is based on any repeating regularity observed in the market. Then he thoroughly tests this system and then follows the rules. Next, and perhaps even more important, a discretionary trader has no way of checking if he has ever been right in any similar situation in the market. Every position is taken without context of previous wins and losses, and it wouldn't be an exaggeration to say that every new entry is a new story for a discretionary trader. A systematic trader can always check if his system reacts adequately in all the variety of market situations. Moreover, a careful systematic trader even will never go live until he is confident in his system. And finally, summarizing all the aforesaid, what's the edge of a discretionary trader? It's mostly his intuition. Very few people have a decent intuition, but those that do made famous traders of the past. Given that memory tends to keep only success, that's exactly why we have heard about Jesse Livermore, for example, although it's known that he lost everything he had a number of times. So, here we are with the first myth that only discretionary trading is able to bring real profits. As a proof of concept, the apologists of discretionary trading provide the very examples that we just mentioned. However, let's try to critically look at this proof from the formal, statistics-based standpoint, and we will immediately note that if put in correct terms, the sample is not statistically significant, and therefore the error can be even larger than the sample itself. Sounds complex? Well, in fact, it's not that difficult to understand. Let's plot historical results of discretionary traders in form of balloons. 4 of them are flying very high. They correspond to results achieved by the greatest and the most famous discretionary traders of the past. If we look at them alone, it indeed seems like the hypothesis about discretionary trading delivering excellent results is correct. However, let's now plot results of other discretionary traders, even only those that were eventually profitable. And now the picture is very far from being idealistic. If we now calculate the error over this dataset, we can see that those 4 excellent results are outliers. This is something abnormal, something that we cannot refer to as proof. So exactly the opposite, the systematical trader's edge is statistics of the proven method. In terms of our illustration, this means that we are not looking for lonesome green balloons, quite opposite. We tend to avoid them intentionally in order to make our distribution of trades more homogeneous. In more familiar terms of trading, we sacrifice the chance of winning big in one single trade in order to improve our chances to win consistently, regularly, and in the long run, we all want slow yet consistent growth of accounts. Well, at least we think we do. What's the implication of statistics being the cornerstone of systematic trading? This basically means that the risks of every trading of the system in whole can and should be calculated in advance, prior to even placing the first order. This way, risks are managed way better than in discretionary trading, and moreover, it opens doors to trading of portfolios of enormous sizes, incorporating hundreds if not thousands of markets, something that is definitely not possible with just human discretion. Sounds exciting? Of course it does. And at this point, many traders, especially those with previous background in mathematics, rush to apply statistical methods to markets. And very often they get disappointed, since the systematic approach is not a kind of a holy grail, and neither is statistics. In order to understand it, let's consider an example. Well, I think you all heard of an old joke about a hospital where all patients have normal temperature on average. It's another story that some of them suffer from fever and others are dead. On average, the temperature is normal. This joke should invoke very serious thoughts about applicability of statistical methods to trading, and these thoughts lead inevitably to a single conclusion, that statistical methods alone cannot be the only tool that provide sufficient edge in the market. That still they require some additional information, some conditions and restrictions in order to be indeed substantial and representative. And here we are faced with the second myth, that there exists a statistical method or an indicator or any other purely technical study, whatever you like to call it, that allows to always win the market regardless of the present state of this very market. This myth is perhaps even more widespread today than the first myth because mathematics today is considered roughly in the same way as medieval people considered wizardry, with mathematicians being modern wizards. Maybe there is another profession that is considered the same way, programmers. Therefore, in the eyes of a modern John Doe, a combination of a mathematician and a programmer is able to really work wonders. And this is exactly what we can see in many Hollywood movies. The reality is again different. And no numeric method alone would ever provide you with an edge by itself if it's not combined with understanding of real market processes that are going on deep down below, well hidden from prying eyes. Well, time went by, and further computerization of markets provided new special types of trading activity to certain classes of market participants. Note that I intentionally emphasize certain classes. These activities have never been available to everyone. Of course, I mean various manipulations with orders, order books, exploitation of latency between different trading venues, and similar activities, including those that are explicitly prohibited today, for example, front running. Regardless of what you think about the moral side of these activities, the fact is that unlike directional trading, where the question of what to do, buy or sell or stay square, requires quite some research and is not universal for any situation, these activities assume quite a logical, understandable, and unambiguous sequence of actions. Therefore, no wonder that the term algorithmic trading first appeared to describe this very type of trading activity. At a certain point, the illusion that some groups of market participants were able to systematically get consistent profits and large profits just following certain formal procedures gave birth to the third myth that algorithmic trading is indeed the long lost and newly found Holy Grail of the market. However, I think you now understand which question we should always ask when we analyze any trading method. What's the edge there? Or putting it in more colloquial terms, why does market owe money to those that use this method? Well, roughly speaking, the edge here is only a technological advantage, being faster than others, being able to send more orders, to stuff the books, to have a last look, and so on. Therefore, algo trading requires very expensive infrastructure, and competition in this domain is very strong, which eventually renders the very advantage not as attractive as it looked originally. This domain lies apart from both discretionary and systematical trading because it does not require to make any suggestions about the future development of price. And on the other hand, it's very hard to test these methods because it's extremely hard, if not yet impossible, to properly simulate the trading environment in which these methods work. Therefore, to bring clarity to the landscape, both discretionary and systematic trading in their classical meaning were named directional trading, and what we just discussed was referred to as non-directional. Okay, the popularity of algorithmic trading in the original meaning of this term was slowly fading with growing sober understanding of the associated infrastructural expenses, and eventually the very term was replaced with high-frequency trading, although originally they were not exact synonyms. Thus, in recent years, the term algorithmic trading started to be used to describe various predictive models for directional trading. So as you can see, the world of modern trading techniques and associated terminology is not easy to follow, right? Well, be a little more patient. We're approaching some clarity. Those modern predictive models that we mentioned indeed use very advanced mathematics that definitely require quite some background to be able to at least understand without even saying of being able to apply. Now, remember the public attitude to mathematicians and programmers. No wonder that the more complex the model, the more credibility it takes, especially from those that do not understand it. The idea behind data mining, machine learning, predictive analytics, and other popular and less known methods is to exclude market analysis as is from the process of designing a trading system. In a certain sense, it looks like an attempt to predict the development of a physical phenomenon based only on some of its visible traces. Well, in some cases, this is the only way to go, for example, in nuclear physics, but without understanding the nature of the process, such a model may be quite misleading. Let's set aside the science of the 20th century and go back 2,000 years. It was commonplace that time that the sun went around the earth. No one doubted the fact, since it was so obviously perceived with eyes. Therefore, no wonder that first quantitative models aiming to describe the sun's movement were also based on this assumption. It's interesting to note that, in fact, it was possible to finally develop a model that described it quite correctly. But the model was quite complex even from the contemporary point of view. Well, we all know what happened afterwards: the introduction of a solar-centric system and dramatic simplification of all calculations, with no less dramatic improvement in precision. Machine learning and other popular methods of developing directional trading models are basically doing the same as ancient people did. They try to put the burden of determining the dependencies between phenomena onto machine, excluding them from logical analysis. And here we are with the fourth myth, that modern complex predictive methods are the ultimate holy grail for modern markets. Unfortunately, we have to state that this is again a delusion. Unlike the Earth that has traveled around the Sun in the same manner throughout the whole history of humankind, markets are different. They are dynamical systems with many external factors that are normally not taken into consideration by researchers simply because their impact cannot be observed within a reasonably short time frame. Therefore, normally, these so-called advanced models suffer from the same disease. They work only while markets are, let's say, static, or to sound a bit more scientifically, while exploitable patterns of behavior have more or less similar representation. When markets change, and I urge everyone to pay particular attention to the fact that it's indeed a matter of when and not of if. So when the markets change, these models will run into losses exactly like any other quantitative model. So now let's look at a big picture. What do we have? We have discretionary trading, which seriously suffers from emotions and other properties of human nature. We have various forms of non-discretional trading, which are viable, but which we don't consider because of the extremely high price of the entry to this business. And we have both classical and modern systematic trading that suffers from repetitive failures of models along with changes in markets. Now, why will market owe money to us? The only way to stay alive in all the ever-changing markets is definitely to exclude emotions using systematic trading instead of discretionary trading. That's right. And to base the models that you use on thorough and exhaustive analysis of the very markets you are going to trade. Only this approach allows to be on time with changes in markets behavior, or if you want better precision, to be there with the minimal possible lag. And here we bust the fifth myth about systematic trading, that only complex models can be winning. Quite opposite. Remember our example with the sun traveling around the earth or the earth traveling around the sun. The same situation is with market models. When you clearly understand the market process that the model is exploiting, then a simpler, a more clear, logical, and straightforward model that describes this process works better than a more complex model that does not possess any logical connection with reality. So this is exactly what lies in the foundation of the EdgeSense method that I originally developed and which gave birth to my company EdgeSense Solutions, which has successfully developed a good number of robust strategies for forex and futures markets, along with special technical methods for developing portfolios with high level of risk diversification and yet understandable and controllable risks. This is the very method that now lies in the foundation of the Certified Algorithmic Trader program that I am running for the Algorithmic Traders Association. So thank you for your attention, and in case you need more information about this certification and about enrollment in it, please feel free to write to info@atassn.com. You can also do that by filling up a form at the classes page of the site. And now I'm ready to answer questions if there are any, so please feel free to ask. The first question is, can you elaborate on the systematic trading and the statistical inconsistency? Well, systematic trading basically is all about statistics. A system can, unfortunately, or fortunately, I don't know, be validated only on certain, let's say, similar sets of data. Normally it's historical data, and we can use certain statistical methods to assess the robustness of this system and its applicability to this particular matter. With this, of course, this is always done with the assumption that the general market behavior is going to remain the same for a certain time. So, statistical methods require a certain amount of data to be considered, so that the result of the statistical research be meaningful. Exactly as in case with that old joke about the hospital. If we have two patients, one of them suffers from fever and the other one is dead, then the average temperature is normal, but this normal temperature is not relevant to this particular situation. So therefore, we should speak about statistical significancy of the data set. And since I can see now another question of how many trades are required for backtesting, this is not a matter of the number of trades, it's more a matter of the length of the historical data, because historical data should encompass all of the four market states or general market conditions. This is something that we discuss in the very first part of the educational course, by the way, when we do the exhaustive market analysis. What is considered good statistics for an equity futures trading system? Again, there is a number of metrics, because there is no single metric according to which we could say that, okay, this system is good and this is not good. First, we always should understand whether this system is trying to exploit something that is persistent in the market for decades, or only something that exists only now. Both approaches are valid. Both approaches lead to profits. You only have to understand what exactly you are trying to explain. Therefore, the metrics can be different. It's not possible to answer this question in this form. Sharp ratio. Yes. Sharp ratio perhaps is the worst metric because, well, originally Sharp ratio was introduced as a metric to evaluate the performance of fund managers that basically only traded buy and hold. Therefore, it did make sense for this kind of activity. We talk about directional trading, especially with shorts and especially with leverage products. It's irrelevant. There are much more interesting metrics. And, well, I always encourage everyone to do their own research on the net. Can you provide specific examples of inputs that have been used in your models that have now become obsolete, and what market events caused these structural changes? Come on, this is something that we're simply charging our fees, because it took me approximately, I don't know, 7 years perhaps to fully understand these dependencies between these external factors, let's say global factors. I only can say that definitely this is not something that can be attributed to Fed decisions or central bank interventions or news or economical indicators. It's something different. But again, you can find it's right away in the net. It's open information. What are the results of your program and over what period? First, I would like to ask which program, because I presently trade at least four for futures and for spot forex, and I don't see any single reason to publish these results here in this webinar because it is simply irrelevant. Hello, would you recommend best time frame to work with? I'm really sad to see this question because this means basically that I wasn't able to convey the main idea of, well, if not systematic trading in general, but at least of my approach. Because the idea is that time frames, indicators, setups, and so on are only tools to formally describe something that really exists in the market. And this something doesn't care about time frames, resolutions, volumes, form of bars, number of bars on charts, and so on. So it's like the proper choice of the instrumentarium to describe, I don't know, the flight of space aircrafts or the movement of a car. In both cases, you have to select the proper set of differential equations. But we cannot say that those that are applicable to calculate the trajectory of a space aircraft are better than those that are applicable to calculate the trajectory of a car. So I hope I answered. Oh, so many questions. Is this webinar recorded? Yes. Trading based on historical statistics versus real-time market conditions provided by Algorithmic. Kindly share your thoughts, please. Again, trading based on historical statistics versus real-time market conditions provided by Algorithmic. Unfortunately, I cannot quite understand the question, so let me better refrain from answering. Question, is there any backtesting program available that has been asked data? Yes, plenty of them. Even in the retail market, at least multi-charts is capable of doing that quite correctly if you know how to do it. What is your average success rate? If you mean the percent of winning trades, then I personally consider it as perhaps the most meaningless metric. Again, let me repeat, the most meaningless metric in systematic trading, because it's very easy to create a system that will have 90% or even 95% of winning trades and still will be losing. But just to answer your question, it varies from approximately 40% to 80% for different strategies, different markets, different systems. Can I have these PowerPoint slides? No, you can't. What is your opinion about MT4 MetaTrader? Well, I had some experience with MetaTrader, perhaps back in its MT3 state. That time it was absolutely useless for anything serious. So since then, I didn't ever try to do anything with it. I have a couple of friends that indeed work with it, and also I know that they are even able to perform reliable backtests there. This the weakest part of this piece of software, because the backtested results there are always better than live results. But I know that it requires quite decent understanding of the internal structure of the software and quite decent programming skills, something that I do not possess. What's the industry standard for when to stop an algo system in a portfolio to put another system into my portfolio? There is no industry standard. I I wish there were, but basically this is again something that we cover in the last part of the course. So the course is something like we start with the market analysis, then we proceed to converting the found ideas into codes, then we discuss what to do with these codes, how to properly backtest, how to do the optimization, and so on. And finally, we talk about the robustness assessment, portfolios, risk management, money management. So these questions, of course, are from the domain of risk management, and this is something. This is a domain where is no industry standard. Every trader, practicing trader, and me no exception, has his own views on it, because these views also are very heavily dependent on the structure of the portfolio, on the idea behind the system, or perhaps the absence of this idea. If you trade, for example, something using predictive analytics, then this answer would be quite different from the situation when you trade something that has reasonable explanation. Your best stock program. Again, I don't quite understand the question whether it is related to the trading program or the trading strategy, that these are synonyms, or a program to trade stocks. So no answer here. Do you prefer stock over forex for better probability? No, I personally do not trade stocks at all. I trade spot forex, certain futures, mostly index futures and currency futures, of course, some commodities futures. And also I developed certain programs to trade ETFs, but these are used by institutions. So I personally do not trade them. Is this record? Yes, it is. Trading based on historical statistics versus trading. So, do you have a book that we can purchase? No, but I do plan to write one. It will be only dedicated not to this method, but mostly to backtesting and optimization done right. Because so far I do not have any plans to disclose my market analysis methodology publicly. What do you use now? Well, now I'm using my finger on a touchpad to scroll through the questions and point them in the list. Would you recommend any trading program? Again, if most likely this is a software related question. I do not want to recommend any program because I'm not affiliated with any software vendor, and I don't want to sound like as if I am. And well, that's it. What software do you use for backtesting? Well, I think everyone knows that I'm using multi-shares. How long have you been trading spot forex? This year it will be the 13th year, I suppose. Haha, I'm glad you liked it. Do you find it difficult to have correct balance in futures trading? Always wrong, don't eat. A little bit hard to answer again, because I don't quite understand the question, but if you mean the correct balance in a portfolio of futures, then frankly, I don't see any serious problem here. What metrics do you use to compare two different trading strategies to identify better one for you? This is something that, again, I cover during the course in most details. What is your opinion about NinjaTrader? I personally never used it because it uses C# as a programming language, and again, I'm not a decent programmer, and therefore I prefer easy language because it's way easier to use. I know that this has a reputation of quite a decent platform, so unfortunately nothing else that I could say. So we ran out of questions. Okay, so Doran.
Yes, very good. Excellent. Thank you. Lots of good questions and active crowd. For some of the members of our association, I want to mention a couple of things. I want to thank you for your membership. I also want to let you know that we were able to negotiate some pretty good discounts for the trade show in Chicago that's coming up in June. We're also, for some of you that are already enrolled in our courses, we're looking at striking a deal with Battlefield and see if we can fast track some of the graduates and get them some funding. So a lot of exciting things happening, and I hope you'll join the next sessions and our next webinars in the upcoming weeks and months. Again, thank you very much, Alex, for your time, and I hope to see everyone soon. Thank you.
Thank you all, and this was very nice to see so many questions and to answer them. So thanks again. Don't forget to join us next Wednesday.